Canada's headline inflation rate slowed to a year-on-year rate of 2.7% in June, and that's a step closer to the Bank of Canada's 2% inflation target. Our guest says policymakers should now have enough confidence to ease policy rates by another quarter percentage point on Wednesday of next week. We're joined by Robert Kavcic, a senior economist at BMO Capital Markets. Robert, it's great to see you. What jumped out for you with these inflation numbers?
Well, I think the first thing is that we got kind of spooked by the May inflation numbers, and the thinking for a lot of us was that we just don't want to see a repeat of May, and we didn't. That's the good news. So we got a much friendlier print when you look across the headline inflation rate and the core measures that was not a repeat of what we saw in May. So from the Bank of Canada's perspective, we already had, 4 really positive inflation reports heading into May. We saw that bad one, and then this one actually came in quite a bit better. So call it a good 5 of the last 6 CPI reports have been on the positive side of ledger. I think that's pretty good evidence for the Bank of Canada to keep cutting rates at this point.
Now, was this enough to get you guys to change your stance? Bloomberg says Bank of Montreal changes rate call. Were you had not anticipated a rate cut on Wednesday of next week?
We came into the year of the view that rate cuts would start a bit later than the market had anticipated, and that proved to the case. So we stuck to our call that we were going to see June start to this easing cycle, which is what we saw. And then after this inflation report, we were kind of hanging out on the sidelines, waiting to see a business outlook survey that continued to soften, which it did, and a CPI report that did not repeat what we saw in May, and it didn't. So that was enough evidence for us there to say, yeah, the Bank of Canada is going to go ahead in July. And by the time we get through the end of this year, I think our call is still consistent. We're going to probably see 4 rate cuts by the time we get to the end of the year. 4 rate cuts,
another 3 this year. Do you think Tiff Macklem would ever go the full hog and cut by half a percentage point, or would he be worried about sending a signal that he's alarmed about the economy?
Well, it might do that, and I wouldn't get too carried away yet, just given that there was, still some signs of stubbornness in the details of the inflation report, right? So, I think when we look at the core measures of inflation, the 3-month moving averages, the 6-month annualized rates, they all have 2 handles, but they're not necessarily all back to the bank's 2% target. So I think from a risk management perspective, they probably don't want to get too carried away easing too quickly with the risk of having to turn around in 2025 and heaven forbid, tighten again. So that's where I think they are. But the flip side of that is we see very, very clear evidence that growth is running below potential. That's obvious. That the job market actually, which has been very strong through this cycle, is deteriorating pretty quickly as well. So there's scope for easing at this point, I think, for sure.
Robert, I'm an inveterate bargain hunter. I rarely buy things unless they're on sale, unless I can avoid it. Is there evidence that, you say there's evidence Canadians are avoiding discretionary purchases, and I think it's CIBC says that inventories are building. So are retailers finding they're loaded up with stock?
Well, I think that speaks to where we're seeing clear disinflation pressure in the Canadian economy, and that's on the goods side. We really don't see any goods inflation at this point in the Canadian economy. The vast majority of it is contained in the service sector, and that's consistent with what our view has been all along. That look, you have a large number of Canadians that are resetting into higher mortgage rates. They're going to pay that mortgage first every month, but what they're going to do less of is probably spend on discretionary goods, maybe go to the restaurant a little bit less, go to one less hockey game, maybe take one less trip during the year. So that's all on the discretionary side of the economy. Mm-hmm. We're seeing evidence of that in the spending numbers and in the growth numbers, and we see evidence of that in the inflation numbers as well, because core goods inflation has melted away, and it was really the first to melt away.
You highlight an interesting thing here, that insurance costs keep going up, not far short of 10% increases year over year, both auto and regular insurance.
Yeah, and that would kind of fall on the non-discretionary side of the economy as well, right? So where there's a lot less sensitivity to the slowdown that we're seeing in growth, a lot less sensitivity to interest rates, and that would kind of fall in that broader service sector basket where Canadians really maybe don't have a lot of choice or ability to curtail spending or pivot into other alternatives. So that's another example of where we see sticky inflation right now still.
And you also note that food costs did edge up for a second month in a row, but that's after several months of declines.
Yeah, food inflation has been showing some progress for sure. The last month wasn't great, but considering where we've come from, I think we've made pretty significant progress. I mean, for Canadians, it's not going to feel great when you go to the grocery store. It doesn't mean your grocery bag is going to get any less expensive, but it's not rising as quickly. So incrementally, that's good news. There are some other areas too that have been really key in this inflation cycle, like shelter costs, as an example. Obviously, shelter inflation is relatively high, but we're finally starting to see some progress on that front too, with pretty clear evidence out there in the market on the ground that rents are stabilizing, if not coming down in some areas. Now, it's going to take time to filter through the CPI, but I think progress has started on that front too.
It's interesting, just on returning to food for a second, wheat has been tanking, corn is down, partly because of the prospects of a big U.S. crop. So that's going to presumably cool off food prices or help cool them off a bit.
Yeah, I think so. And keeping in mind that food inflation in Canada is very much dictated by market forces, kind of outside the scope of what we see here domestically, right? So think of things like oil prices to transport the finished product, or things like supply shocks, as you mentioned, in grain or various other commodities, the Canadian dollar as well. These are factors that typically drive inflation at the grocery store. And these are, all kind of reasons why it was pretty easy to predict. I don't want to say easy, but it was pretty well telegraphed that we were going to see this slowdown in food price inflation, because all these macro factors outside of Canada specifically were all pointing in that direction for the last year or so already.